All right, folks, we're back. So this is going to get us started with section 29.1, which is going to focus on how the foreign exchange market works. The section is going to look at the mechanics of currency exchange. We're going to identify some of the major players. We're going to explain some of the language we use to describe currency movements. Buckle in. This is a bigger section. It's a bigger part of the chapter. We'll get through it as fast as we can, though. So let me switch over to the slides. Our learning outcomes, we need to define foreign exchange market, describe different types of investments like foreign direct investments, portfolio investments, and hedging, explain how appreciating or depreciating currency affects exchange rates, and identify who benefits from a stronger currency and who benefits from a weaker currency, who are the winners and losers. So most countries around the world operate with their own distinct national currencies. Each sovereign nation issues its own money and backs it with its domestic policies. That's not always the case, though. There are some interesting exceptions that highlight some important contrasts in the global monetary system. For instance, some smaller economies, particularly those in South America, have chosen to dollarize, meaning that they have adopted the US dollar as their official currency. Countries like Ecuador, El Salvador, and Panama have done this. And more recently, there's been a lot of discussion from the president of Argentina, Javier Milei, about potentially dollarizing Argentina's economy, moving them away from the peso. And that may actually happen. I suspect it will. And I suspect it'd probably be a good thing for Argentina to do that because they've had a lot of issues with their monetary policy. They basically would outsource that to the United States. But this just illustrates how significant such a policy decision can be. Another notable exception is when nations share a common currency like the euro. 17 European nations, including major economies like France, Germany, Italy, they've all replaced their national currencies with the euro starting in 1999. But even with these exceptions, the vast majority of international economic activity still involves multiple national currencies, and nearly all cross-border transactions therefore require some form of currency conversion. So what exactly is this market where currencies are exchanged? We call it the foreign exchange, or the FX market. This is the global marketplace where people and firms use one currency to purchase another currency. The participants in this market are diverse, including households and businesses and governments and large financial institutions. Fundamentally, across every cross-border activity that you can imagine, whether it's selling goods to another country or buying raw materials from abroad and importing those, hiring international talent, borrowing money from a foreign bank, traveling overseas, or making an investment in another nation or into another business in another country. Any of that triggers activity in the foreign exchange market. Without the ability to exchange currencies, these international interactions simply just could not happen. So at its core, an exchange rate is simply the price of one currency expressed in terms of another currency. And it's always that expression. I kind of mumble my words through. I always get confused. Like, is this a $1 equals $1.15 of this? No, it doesn't. But I try my best. But just like any other price in economics, these exchange rates are best analyzed using supply and demand. The supply of a currency in the foreign exchange market arises when economic agents are willing to trade that currency away in exchange for another. And then conversely, demand for a currency arises when agents wish to acquire it, usually because they need it to make purchases or investments in the country that issues that currency. And so the basic framework of supply and demand is going to be our guiding principle as we explore what causes exchange rates to change. So now let's consider the sheer scale of the foreign exchange market. To put it very simply, it's the largest market in the world economy. So to put this into perspective, a 2019 survey by the Bank for International Settlements found that approximately $6.6 trillion, capital T, trillion dollars in foreign exchange was traded daily. So to give you a sense of just how enormous that figure is, I know it's we throw around these trillions left and right. To give you a sense of it, though, the entire 2019 GDP in the United States, the US GDP, was around $21 trillion, capital T, in the entire year, 365 days. So the $6 trillion daily turnover in foreign exchange markets is equivalent to nearly a third of the entire annual US economic output for the year. So it's a staggering volume. And it means that the FX market dwarfs the trading volume of all other markets for goods, services, and even equity combined. Its immense size reflects the deep interconnectedness of our global economy. So to illustrate how a retail exchange transaction works in practice, imagine that you're a traveler with a $100 bill at a currency exchange booth in Istanbul, Turkey. And you look at a digital board there and it might display something like US dollars, buy 550, sell 580 for Turkish lira. This means that if you want to buy Turkish lira with your US dollars, the office there will give you 5.5 Turkish lira for every $1 US dollar. So with your $100, you would receive 550 Turkish lira. Now, if you were to later sell those 550 Turkish lira back to the same office to get US dollars, they would buy them from you at the sell rate, which is 5.8 lira for every $1 US dollar. This means you'd get back approximately $95. So yes, you've lost $5 in the exchange. That's their fee. The difference between the buy and the sell rates, in this case 550 and 580, is known as the spread, and it represents that built-in commission or profit for the currency dealer. It's how they make money on each side of the trade. And in this simple transaction, when you multiply it by millions worldwide, well, it contributes to that massive $6.6 trillion daily trading volume that was just discussed. So when we look at the foreign exchange market, certain currencies dominate the landscape. And this table is based on data from September 2019. It shows the currencies most frequently traded. And unsurprisingly, the US dollar takes the lead, appearing on one side of this, 88.3% of all foreign exchange transactions. Something to be thinking about. Following the US dollar are the euro at 32.3, the Japanese yen at 16.8, and the British pound at 12.8. Other significant currencies, the Australian dollar, the Canadian dollar, the Swiss franc, the Chinese yuan. Now, you might notice that these percentages are adding up to more than 100%, and that's not a mistake. It's simply because every single foreign exchange transaction involves two currencies. So each currency is involved, is counted here, and so some double counting has to happen. In case a US dollar is exchanged for a euro, well, there's some double counting happening here. But this clearly shows the United States dollar's pivotal role in our global financial system. While the foreign exchange market involves some complex financial institutions at its most fundamental level, the activity is driven by four core groups of agents. These groups are the primary demanders and suppliers of currency in these exchange markets. First, we have trading firms who are engaged in the import or export of goods and services. These are businesses that earn revenue in one currency but need to pay their costs in another. Second, you have tourists visiting other countries, and they also play a role converting their spending money for overseas travel. Then third, we have foreign direct investors, or FDI, and they engage in more substantial cross-border investments. This involves purchasing at least 10% of a foreign enterprise or establishing a new facility abroad. And then finally, there are portfolio investors who shift short-term financial capital without taking on any kind of managerial responsibility. These four groups collectively drive the demand and supply of currencies in the global marketplace. So let's look a little more closely at how international trade specifically drives these currency flows. For firms who are operating across borders, it's common for their costs of production to be measured in one currency while their revenues from sales are in another. For example, imagine a Chinese firm that exports electronics to the United States. This firm earns US dollars from its sales, but to pay its workers, suppliers, and investors who are based in China, it needs Chinese yuan. And so in the foreign exchange market, this Chinese firm is therefore going to be a supplier of US dollars, selling the dollars that it earned from its product sales, and it's going to become a demander of Chinese yuan, buying whatever yuan it needs to supply its employees and suppliers. Any movements in the exchange rate between the US dollar and the Chinese yuan is going to directly influence their profitability once the currency conversion occurs. And if the yuan suddenly strengthens against the US dollar, well, that Chinese exporter might find its dollar earnings translating into fewer yuan, cutting into its profits. This direct impact on profitability is why exchange rate movements are so critical for globally engaged businesses. Beyond trade, currency exchange is also heavily influenced by tourism. When you, as an outbound traveler, decide to visit another country, you need to acquire the local currency. This means that you will supply your home currency, United States dollar probably, into the foreign exchange market and then demand the destination country's money. For example, an American tourist visiting Beijing is going to supply US dollars and demand Chinese yuan to pay for hotels, meals, souvenirs, what have you. The reverse is also going to be true. Inbound tourists, foreigners coming into your country, create the mirror image of this activity. They supply their home currency and then they demand your domestic currency to spend. This influx of foreign currency from inbound tourism then affects local retail sectors and service providers, hotels, restaurants, tour operators. It's injecting foreign spending power into the local economy. Another significant driver of currency flows from international investment, which we generally divide into two main categories: foreign direct investment, or FDI, and portfolio investment. FDI, foreign direct investment, involves purchasing a substantial ownership stake, typically at least 10%, in an existing foreign firm, or even starting maybe a brand new enterprise in another country. This type of investment usually implies a more long-term commitment and involves some level of managerial responsibility. Good example of this is 2008 and the acquisition of the Anheuser-Busch by the Belgian brewing company InBev for $52 billion, billion with a B. To make this purchase, InBev, a European country, had to supply euros to the foreign exchange market and then demand US dollars. In contrast, portfolio investment refers to a purely financial investment in another country that does not involve any management responsibility. These investments are typically more liquid, they're easily convertible or sellable or reversible. An example would be a US financial investor, me, you, anybody who has a trading account, purchasing a UK government bond or depositing money in a British bank. In this scenario, the American investor supplies US dollars and demands British pounds in the foreign exchange market. So both FDI and portfolio investment, regardless of their nature, they inherently require the investor to supply their domestic currency and then demand the foreign currency of the country where this investment is being made. So now let's consider how a portfolio investor might try to benefit from expected exchange rate movements, which is a form of speculation. Anytime you expect the movement to do one thing or another, you're speculating on the foreign exchange market. So this figure illustrates a scenario where an international investor anticipates that the British pound will appreciate against the US dollar. Suppose the current exchange rate's $1.50 US per British pound. An investor expects this to rise to $1.60 per pound within a month. They're speculating. To capitalize on this, the investor would take $24,000 in US currency and convert that into 16,000 British pounds at the current exchange rate. If they predicted correctly, the exchange rate does change to $1.60 per pound after a month, then the investor can convert their 16,000 euros back to US dollars, and that would yield not to the $24,000 they put in, but $25,600. So they're going to get a nice profit for doing nothing of $1,600 just based on speculating on the foreign exchange rate. This example demonstrates how expectations about the future value of a currency can be a powerful driver of demand and supply in foreign exchange markets. It also illustrates, I think, what you should be understanding is that there are winners and losers here. Right? That $1,600 didn't appear out of thin air. So we've seen how speculative portfolio trades actively chase expected exchange rate shifts. For instance, if the pound is expected to rise from $1.50 to $1.60, and you put money in, and a month later you get more than what you put in, right? That's what we're talking about. That's this anticipation that can lead to someone making a decision to invest, which is immediately shifting ahead of what may actually happen, immediately shifting the currency demand and supply today based on what may happen 30 days from now. Not all financial activities like this are about speculation, but some of them are. Firms also engage in hedging, which is another practice for protecting against adverse movements in the exchange rates. So imagine that you're a US exporter who has a contract to receive €1 million a year from now for products that are shipped to France. You're going to get this €1 million a year from now for products that you're going to ship to France. Well, you don't know what it's going to be, what the currency exchange rate is going to be a year from now. So you're facing currency risk. And to eliminate this uncertainty, you can pay a fee today to a financial institution to lock in a specific dollar value for that €1 million you're going to get a year from now. Uses some time value of money techniques to make that determination what that fee is going to be. They're basically charging you interest. It's kind of like that. But the financial contract you sign with that fee guarantees a certain exchange rate 1 year from now, regardless of what the market rate is at that time. So you're kind of transferring the risk to the financial institution, and they'll be taking all kinds of different risks as that's their business model. Some they're going to win on, some they're going to lose on, but they're collecting a fee every single contract. So that's how a hedging system works. It allows businesses to kind of focus on their operations rather than having to constantly monitor the currency exchange markets. This table here gives you a more concise summary of some of the major demanders and suppliers of US dollars. We've already talked about this a little bit, but you can study this a little on your own time if you need to pause and move on. So it's important to understand that the foreign exchange market doesn't operate with individual buyers and sellers directly finding one another. Instead, it has a sophisticated institutional structure. Most sizable currency exchange orders flow through commercial banks, which act as foreign exchange dealers. I know we talked about the example in Istanbul where you just walk up to the store and there's a sign out and it tells you what the spread is. That's not how most currency exchange works. Most of it is through these commercial banks, these foreign exchange dealers. These dealers, which trade currencies with each other and are what's known as, when these dealers trade currencies with each other, that's what we call an interbank market. One bank is trading with another bank. Globally, there are about 2,000 firms that operate as foreign exchange dealers. In the United States, there are fewer than 100, but a small group of the largest 12 or so dealers execute more than half of the total transactions. This market doesn't have like a central trading floor like you would think about the stock market maybe having. Instead, its quotes for currencies circulate continuously among dealers via electronic networks. It allows for lightning fast transactions around the clock. It's an enormous daily turnover, that 6 trillion capital T dollars that we talked about. That's coming chiefly from these interbank transactions, these electronic networks. And most of that really is from portfolio flows, not so much from the direct foreign investment or the tourism. It's mostly from portfolio flows, which meaning, I want to invest my money into a foreign company. I could issue a buy and I could trade my US dollars for that foreign company's Toyota, for instance. I want to buy some Toyota. I'll go to my trading platform. I'll type them in and I'll say, give me 5 shares of Toyota. Well, Toyota's a Japanese company, so there's going to have to be an exchange rate to make that work. Right? So that's just a constant buying and selling of these transactions among these dealer institutions. It's not primarily tourism or merchandise trade. So it just underscores financial transactions are the dominant form here. So when we talk about currency movements, the terminology can sometimes be a bit confusing because it's different from how we describe other prices. When an exchange rate for a currency rises, meaning one unit of that currency can now buy more of another currency, we say that it's appreciating or strengthening in value relative to that other currency. So think of it like this. Your currency is getting stronger, it's appreciating because it has more buying power internationally. On the opposite end, when an exchange rate for a currency starts to fall relative to the other currencies, meaning one unit now buys less of another currency, we refer to that as depreciating or weakening. And in this case, your currency is weaker because its international purchasing power has declined. So a crucial point here is that unlike ordinary goods where a price rise, an increase in price benefits the seller and hurts the buyer has to pay more, the seller gets to keep more. With currencies, the price of one currency is simultaneously someone else's price in reverse. So two currencies cannot both strengthen against each other at the same time, is what we're trying to get to here. If the US dollar strengthens or appreciates against the euro, well, it automatically means that the euro is depreciating or weakening against the US dollar. And it's always this reciprocal relationship. There's a winner, there's a loser, there's a strengther, one that's stronger, one that's weaker. This figure demonstrates how exchange rates can fluctuate quite substantially, even between economically integrated neighboring countries like the US and Canada. The top graph shows the Canadian dollars. See if I can zoom in a little bit more on that one. The top graph here shows how many Canadian dollars are required per one US dollar. The bottom graph, you can kind of see it's got this opposite mirror effect happening. The bottom graph presents the US dollars required per one Canadian dollar. So you can kind of see that if they're mirror images of one another for the most part. They're not maybe completely perfect, but they're pretty darn close mirror images of one another. If you flipped one around, it would look like the other one, I guess is what I'm trying to say when I say the word mirror images. And it just illustrates that there's this, this principle of reciprocity or connectedness, where the depreciation of one currency means that the other by default is strengthening or appreciating. That's all we're saying. It's a zero-sum game between any two currencies. So I had some more slides planned, but after I looked at them, I realized this is the most important thing. So as long as you get this, you're in good shape. I'm going to delete the rest of the slides that I had planned, and I will see you all in the next video when we get to section 29.2. Have a good rest of your day.